Hey everyone, welcome back to Corporate Decoder, the place where we unpack the real stories hidden inside corporate jargon. So get ready because today we are diving into a special kind of filing, the one that announces a company is officially ready to go public. So what is this all about? Well, it looks like OneIM Accession Corp, a company that was formed to acquire or merge with another business, has just completed its initial public offering or IPO. This means they've sold their shares to the public for the first time and are now officially a publicly traded company. This report is essentially their announcement to the world that the big event has happened. It details the agreements signed, the stock they are offering, and how much money they raised. Let's look at what they're selling. They are offering something called units. Each unit is a package deal. It contains one share of their class, a stock plus a tiny fraction of a warrant. Think of a warrant as a coupon that lets you buy more shares later at a set price. In this case, one unit gets you one share and 1/6 of a warrant. And for every 6 warrants you collect, you can buy one whole share. These shares and warrants will be traded on the Nasdaq, which is a major stock exchange, so people can buy and sell them easily. One thing to note is that they have checked the box saying they are an emerging growth company. This means they are a newer company and can follow some slightly different rules for reporting their finances for a period of time. This is pretty common for companies just going public and is designed to make it a bit easier for them as they grow. The big news here is that after their registration statement was approved by the SEC, they officially closed their offering. This means they sold a whole lot of these units to the public. They sold over 28 million of these units. That's a massive amount of stock. The actual shares themselves are Class A ordinary shares. The par value is a very small technical number, just 1/10,000th of a dollar. Per S-hair, a common practice to keep things simple on paper. And of course we have those warrants again. Each whole warrant allows someone to buy a Class A ordinary share for $11.5. To make all of this happen, they had to sign a bunch of important documents. First, to raise the underwriting agreement. This is the deal between the company and the investment banks, like Deutsche Bank Securities Inc., that help them sell the shares to the public. These banks are called underwriters. Then to raise the warrant agreement, this document lays out all the rules for those warrants we talked about, how they can be exercised, and who is responsible for managing them. Continental Stock Transfer and Trust Company is acting as the warrant agent. To raise also a letter agreement involving the company, the sponsor, which is likely a founding group or early investors, and the company's officers and directors. This agreement probably covers things like their roles and responsibilities. This one is crucial. The Investment Management Trust Agreement outlines how the money raised from the IPO will be held. A large chunk of the IPO funds typically goes into a trust account and can only be used for specific purposes like acquiring another company or returning the money to investors, if that doesn't happen. Continental Stock Transfer and Trust Company is the trustee here. The registration rights agreement is for the investors involved with the company before the IPO. It gives them the right to have their shares registered so they can be sold publicly. And finally, the private placement units purchase agreement. This is about selling some units directly to the sponsor, also at $10 per unit. Speaking of those private placements, the company also sold 200,000 units directly to the sponsor. This raised another $2 million. These sales are often made under an exemption from registering every single share with the SEC because the investors are typically sophisticated and the number of shares is limited. Now let's talk about leadership changes. As part of going public, it looks like 2 new directors, Mark DiPolo and Anthony Sheriff, have been appointed to the board. They've also been assigned to key committees, the Audit Committee and the Compensation Committee, with Mr. DiPolo chairing both. The company has also entered into indemnity agreements with these new directors, as well as its Chief Financial Officer, Gregorios Kapinas, and Chief Executive Officer, Ioannis Papilis. These agreements are basically promises from the company to protect these individuals legally if they face any lawsuits because of their work at the company. It is a standard practice to attract and retain talent, especially for public companies. The company also updated its official governing documents, the amended and restated Memorandum and Articles of Association. This filing confirms that these changes have been officially made with the Cayman Islands Registrar of Companies. Here is where the money truly comes into play. A significant amount of money raised from the IPO and the private placement was placed into a US-based trust account. We're talking about $287.5 million in total. This money, including the underwriter's deferred discount, is held by the trustee. This money is locked up and cannot be used until the company either completes its initial business combination, which is the whole point of these special purpose acquisition companies or SPACs, or if it fails to do so within a specific time frame. If they cannot find a company to merge with in the expected time frame, typically 24 or 27 months, investors who bought shares in the IPO will get their money back. This is a core feature of SPACs, providing a safety net for investors. To announce all of these significant steps, they issued press releases. One on the 13th of January announcing the pricing of the offering, and another on the 15th of January announcing the closing of the offering, which means the deal is done, the shares have been sold, the money has been raised. Finally, the end of the document lists all the exhibits filed. These are the actual legal documents that back up everything reported here. Think of them as the detailed blueprints of the agreements we've touched upon. So what does all this mean? OneIM Accession Corp has successfully navigated the complex process of going public and has raised a substantial amount of capital. They are now in a position to execute their strategy, which for a company like this is typically to find and merge with another company, usually in a specific sector, a process that should happen within a set time frame to avoid the trust money being returned to investors. The leadership changes and the protective indemnity agreements are standard moves to strengthen the company as it enters the public markets. The key thing for investors to watch will be how quickly and effectively they can find a suitable business to acquire. The clock is ticking on that trust fund, and the market will be looking for smart strategic moves. Not just a quick deal to avoid liquidation. There is a lot of capital here, and the pressure will be on to deploy it wisely to create value. Alright, that is our breakdown of OneIM Accession Corp's IPO filing. What do you think about their strategy and the potential for this company moving forward? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more in-depth corporate breakdowns. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next video.